Good afternoon, ladies and gentlemen. Welcome to our ongoing series of Market Masters. I am Shailendra Bhatnagar and with me is Sakshi, Batra. In this segment, we make you meet the finest there is on the Lal Street, who come and share their thoughts, investment ideas, where the markets are headed, and how you would invest over the medium term to gain supernormal interests. Our guest today is a young man with a phenomenal ability to pick winners and multi-baggers from an age that was younger still. Please join me in welcoming Mr. Ravi Dharamshi. He's the founder and managing director of Valuequest Investment Advisors. This is a 16-year-old portfolio management scheme, and Ravi belongs to a family of stock pickers. He was amongst the very few young Turks who came out of Mr. Rakesh Jhunjhunwala's equity stable, Rare Enterprises. Ravi was an analyst under Mr. Jhunjhunwala between 2003 and 2007. Welcome, Ravi, to Market Masters. It's such a pleasure to host you. Tell us your view about global interest rates. Tell us your view about global interest rates. We've seen a bit of a problem coming in from Wall Street that's impacted sentiment negatively on Dalal Street. How are you watching the global markets as of now, and where do you think sentiment is at this moment on Indian markets?
So clearly we are more on the optimistic side in terms of sentiment, Shailji. But I'll just say that despite the rise in interest rates, the sentiment has not dampened in US as well. And if US as a market is not collapsing, then we should be less worried about it. So overall today, if you see, the global scenario is not a very optimistic one. There is a China which is slowing down, and there is a US where there could be a potential recession because of the rise in the interest rate. So outlook is more of a circumspect one, skeptical one, rather than of an optimism. But within the whole world thing, India is far more optimistic because we have actually managed to avoid the kind of inflation that, or the stagflation that some of the developed world is seeing. We have managed to keep our growth rate above 6.5%.
There seems to be an issue with Mr. Dharamsi's link, but till the time we sort it out, I'll just give you a bit of more background on Ravi. I think he's back with us.
I'm sorry, can you hear me?
Yes, Ravi, please continue. You were mentioning that it's a stage of cautious optimism.
Yeah, so globally there is a lot of skepticism and there is a possibility of a slowdown. But domestically, India is actually quite doing well. And if I may hazard, I would say that it is on the verge of booming. If it gets the tailwind of global economy, then we will do very, very well. So I think RBI is doing a good job of managing the inflation and the growth both. So we remain optimistic on the Indian markets.
Right. Ravi, let's now start drilling down on your thought process, which will unfold over the next 2 or 3 years on the markets. Of course, Ravi manages Valuequest Investment Advisors, and their peak fund is Valuequest Growth. It has a corpus of 6,000 crore rupees, and over the last 13 years, the annual CAGR return has been in the vicinity of somewhere like 19 and 20%. That's the kind of growth that Ravi generates over the longer term. Ravi, coming to mid caps and small caps, I mean, August has been fantastic, and 2023 years so far has been the year of mid caps and small caps. A 22% return straight on the index only as far as mid caps are concerned. Are we in an overheated environment? Are you changing your filters to choose mid caps, because that is the only place where you get good quality multi-baggers over the medium term?
So allow me a little bit of latitude. I'll try and explain this with a little bit, I'll take my time. So it is to do with the stage of the business cycle and the economic cycle that we are in. What had happened is, if you remember 5 years back, there were very few companies that were doing well. You could count them on fingers, 8-10 companies only that were doing well. because that was a stage at which our profit pool was shrinking, and that profit pool was getting divided amongst few companies. So basically, the theme that everyone talks about, strong getting stronger or big getting bigger, was very much in force. But post COVID and post the tax rate cut, what has happened is there has been broad basing of the economic cycle. There are many sectors that have started doing well, and there are many companies within those sectors that are doing well. Now, in that kind of a scenario, when we are in an upcycle, usually mid and small caps tend to do better than the large caps, and that is exactly what is happening today. Yes, some amount of valuation have stretched a little bit beyond our comfort zone as well in some pockets, but I still believe that this upcycle in the business is going to last another 3, 4, 5 years at least. And if that is the scene, then there is a far more opportunity to generate alpha in these smaller names as well. And I'm not really worried, so to say. There is no overall bubble in the market or any such thing. There is some optimism, but optimism is justified.
Okay, optimism is justified and no bubble. That has been a clear worry, but I wanted to extend this a little further on the valuations part only. As far as the Indian markets go, I wanted to understand from you, Mr. Dharamshi. History indicates that when one buys the market at these levels, 17, 18, times 1 year forward, rarely does one make, double-digit returns. Are these going to be different times, because the way India's narrative is growing is somewhat much different than what we've seen in the past in the global context? Your thoughts, sir?
No, so you are right. One has to be careful about the entry point, and generating returns can be a challenge from here. But let me just say, see, markets karma is, or rather the nature is to move from one extreme to another extreme. And as a rational person, we all try to say that, if market has gone up, we should be a little skeptical and we should tone down our optimism. But I am not from that camp, school that believes that, I would rather focus on what's going to happen rather than what one should be, all the time focused on that correction or whatever is coming up. So this is not any different, so to say, but it is a business cycle. Our corporate profit to GDP is had bottomed in March 2020 at about 1%. That has bounced back to about 4.2%. There is still room to grow. The GDP, if it goes from $3.5 trillion to about $7 trillion economy, then the PAT to GDP, if it goes from 4% to 6-7%, which is where it had peaked in 2007, then we will have a profit of about $350 billion. And if you give that, let's assume there is no re-rating, but the multiple remains the same, which is about 19-20 times 1 year forward, then 20 times multiple will mean the overall market cap of India becomes $7 trillion. Now, if the entire market is going to double in a 4-5 year horizon, our job is to find companies where you can actually generate 3x, 4x kind of a return. So I strongly believe that those opportunities exist even at this juncture, where you can make 3x to 4x over a 5-year horizon. But this 5-year horizon means by default there will be at least 10% correction, if not more, and there will be at least 30% correction. It is not going to be a one-line straight journey. It will have its up and down. So one has to take cognizance of that, but take advantage of those volatility rather than getting scared. When you see those 10-15% kind of pullback in the market, think about deploying more money rather than withdrawing from the market.
Wonderful. And perhaps that is, wisdom coming in from the king of volatility, under whom Ravi Bhai worked over a period of 4 years. And of course, he remained in touch with Mr. Jhunjhunwala over an extended period of time. Ravi Bhai, you talk about multi-baggers over the next 5 years, where you could make possibly 4x, 5x returns simply based on earnings growth. I'm not sure whether you'd like to name stocks, but definitely sectors where Valuequest has its radar. And where do you think such multi-baggers reside at the moment?
So thanks for that question. And you are right. I will not speak about any one particular company, but there are some themes which excite us a lot from the next 5-10 years point of view. And some of the themes, I'll just name them. Financials is one thing that we are very bullish on. Second is the manufacturing in India. And the third is the energy transition. I will just detail out each opportunity a little bit more. That will give you some perspective. Let's start with financials. Financials can be divided into lending and non-lending. See, in the lending space, we are at a stage, in fact, last 2 years, finally the growth has come back. Okay, the banks are very well capitalized. There is credit growth returning finally to the economy, and there is no NPA cycle, asset quality being deteriorating anywhere. There could be a possibility that 3-4 years down the line that these asset quality issues crop up. But right now we are in a stage where the optimism, the business optimism, the consumer confidence is high, and there will be re-leveraging of the economy that will be panning out. So financials will do well. There will be some hiccups again related to the NIMs or margins because the interest rates go up and down. But overall, the credit growth cycle is intact and it will remain so. That is one space. Second space is the non-lending financial. Within that also, there are insurance companies, market infra companies, wealth managers, all those kind of companies. They are essentially a play on the financialization. What is happening is India is going from being a physical assets oriented economy to a financial assets oriented economy. And within that financial assets, of course, the money is flowing into various asset classes, but it is flowing into equity markets also. And that, I think, is something that we can actually capitalize on over a 3-5 year horizon. So whether it is exchanges, wealth managers, or penetration of insurance products, all those things is a great opportunity. And these companies are actually available at a decent multiple. So financials is one space where we believe there is a possibility of growth plus re-rating, because last 5 years have not been great. There has been a lot of competitive intensity. There has been a lot of regulatory pressure on the yields, which has led to the valuation correcting. So now the positive cycle has started, and I believe even the regulatory push will ease a little bit from this point on, and we should have a good clean run for the next 3-5 years. So that is one theme. Second theme is the overall manufacturing or the capital goods cycle in India. So we had almost peaked in 2010, and there was a 12-year period where the capex cycle would just not pick up. Central government had been doing the heavy lifting since last 4-5 years and spending in the money in the economy. But now, since last 1 year, the private capex has also started. And why has it started? Because first of all, the profit cycle started. What happens is usually first the companies need to start making money. Once they start making money, then they get the confidence to invest for their future. And this process of investing for the future usually lasts a 3-4 year period. It's not like overnight suddenly there will be an oversupply situation or something. And that confidence has taken a long time coming. See, in the last 5-7 years, we have had all kinds of crises, from demonetization, GST implementation, IL&FS crisis, COVID. Everything led to crunching of the informal economy. Everything led to the money rolling, getting lesser and lesser in the economy. So now finally the money has started rolling. The confidence is back. Corporates have started borrowing and investing for the future. So that is leading to a cross-sector boom in the capital goods. And then within capital goods also there is manufacturing, which is another thing where the world is moving away from China and is looking for an alternative vendor or an alternative source of supply. And India is actually in the right place at the right time, and they will be able to provide that opportunity. So we will be able to take away some market share from China over the next 5-10 years. So Indian manufacturing is really booming at this juncture. The last theme that I want to just spend a couple of minutes on is energy transition. See, the world is moving away from fossil fuels and it is moving towards green renewable energy. So there are various things, whether it is solar, wind, biofuels, hydrogen, electric vehicles. There will be many sub-themes within energy transition that is the future trend that is panning out. And we need to take advantage of that. This is going to be the largest capex on globally, the largest capex ever by humankind. Okay, I think almost more than $1 trillion per year are going to be spent on moving away from fossil fuels. And it is not one country that is doing it, the entire world is doing it. So if you can find companies that are selling picks and shovels to this opportunity, then that is a great place to be from a next 3, 5, 7 years point of view. So these are some of the themes that really excite us over the next 5, 7 years period.
Okay, financials, manufacturing in that capital goods space, and energy transition, the three broad themes. If you are a long-term investor, have been thinking of creating a portfolio over the next 5 years, 10 years or so, these are the three themes that are likely to give you supernormal returns going forward from here too. So we'll get into the details and several other sectors, but let me kickstart with our viewer question answer session as well. The first question for you, Mr. Dharamshi, that we have received is from Chandigarh, and Harpreet Singh has sent us this question and wants to know that, how should one approach the IT sector right now? Is it out of the woods?
So, good question. Harpreet ji, I don't think this sector is yet out of the woods, but IT is not one sector. There are many sub-sectors, and you can find some good opportunities within IT also. So the large IT services company that cater to US and Europe as a geography, those are the companies that are in a little bit of trouble. One, because their size is very big, and two, because their end clients are facing some issues. But besides that, there are some small companies, there are engineering R&D companies, there are platform companies, there are digitization plays available, and there are some product companies also. So those segments within the larger IT umbrella are actually doing quite okay. If you have to find, if we are bullish on, let's say, energy transition, within that energy transition, electric vehicles, then if you can find companies that are actually, in some way catering to this EV, then that is a play for the future. So that is a more focused way of approaching this opportunity, rather than saying IT sector overall what it looks like.
Right. And Valuequest Growth has amongst its top 5 picks a company called KNS Technologies, which has given supernormal returns. I am very sure that even if I ask a question on this particular stock, Ravi will decline to answer given the regulatory environment that we are in. But let's take this discussion forward. Ravi, we've seen India as a manufacturing hub right through the mid-80s when Maruti set up its factories to come out with the Maruti 800, and the auto ancillary space has now perked up over the last 5-6 months. What are the 2 or 3 things that you see in this space, and are some of the companies from the auto ancillary space on your radar?
No, so absolutely. Auto ancillary forms very much a part of the manufacturing theme which we are bullish on. And it is one space where we have actually managed to take away a decent amount of market share in the world. So we are the largest small car manufacturer in the world. However, our bullishness at this point of time is less on the exports and more on the domestic market. So you have to find within auto components companies that are kind of catering to the domestic market. But there are a lot of cross currents within the auto also. There is the e-two-wheelers trend which is picking up, and one cannot be very sure which particular players will emerge the winner at this point of time. It is still a very nascent stage in that sense. The e-two-wheeler market share would have reached about 4-5%. And once that reaches about 10% is when it becomes clear who are the going to be the winner in this particular space. So, but we like auto component as a better way of playing these themes, because you don't have to bet on which model will do well. You have to just figure out which are the companies that are catering to all the top players, and that those are the companies within auto component that should do well going forward.
Well, that's a lovely strategy, just to focus on the OEM suppliers to the biggest players in the auto sector. Ravi, just as you mentioned, a lot of money moving into non-lending financials, people who manage wealth, people who are insurers, exchanges in particular. There is also a segment which is growing very rapidly in India, which is discretionary spending. You go to a shopping mall and you see people shopping like mad. At least in a city like Delhi, we belong to the club of shoppers, and we have no qualms in accepting that we really like to shop. And I'm sure that's the story all across India. Weddings are bigger and better, flats are getting bigger and better, cars of course are getting better and better, more expensive and more expensive. How are you playing this theme? What is your understanding of the discretionary spender in India who has say an income level of 1 crore plus and is spending very heavily on the economy?
So definitely consumption as a theme in India is here to stay with the next 10-20 years point of view. As we go from being a $2,500 per capita income country to a $4,000-5,000 per capita income country, the discretionary consumption is just going to boom. What we have witnessed post-COVID is that there has been a K-shaped recovery. The lower end of the economy has actually struggled, while the higher end of the economy has had more money to spend because they, for a couple of years, they didn't go anywhere, didn't do anything. So there were far more savings. So there is almost a revenge kind of indulgence that, the top end of the economy is doing. But which has led to 2-3 years of sustained, real estate boom or luxury car boom. All those kind of things are panning out. My assessment is over the next 6 to 12 months, that will kind of, for the time being, plateau out a little bit because that pent-up demand has played out right now. Now, I think it's time to actually focus on the lower end of the economy where the consumption, I believe, will start picking up. Why? Because the rural and agri theme is actually now beginning to do well. This being a pre-election year, there is going to be some money spent at the ground level, which will lead to some increase in consumption. So small ticket items, staple items, I think there will be a growth pickup for sure. If you can find rural agri focused themes, that would be a great way to play this recovery. So also if real estate has done well, there is usually building materials that follows it. And I'm not talking about steel, cement, which are kind of core sectors, but I'm talking about whatever goes into a house. Once you buy a house, then you appoint an interior designer architect who actually designs your home, and then all the things that go into your home will have a good period for the next 2-3 years because real estate has had a good time over the last 2-3 year period. So that is how we think about the consumption cycle. Overall consumption cycle will keep booming, but within that there will be rotation from one particular segment to another particular segment, but this opportunity is here to stay.
Okay. Mr. Dharamshi, one or two more pockets that I want to discuss with you. You did point out how the markets may not go up in a straight line, but there have been so many pockets that have actually just skyrocketed, like the Chandrayaan, the defense space, for example, the railways theme, for example. How are you looking at some of these themes that have really outperformed the markets over the last few months odd or so? And do you think that these spaces are now overheated? Or do you think that with newer missions being announced, the defense space is perhaps going to be a theme of the long term?
So, as contradictory as it may sound, I think both the things are right. One, the longer term theme still holds, but in the short run, it is overheated. So, we have been lucky enough to invest in defense and railways, both the themes, and the stocks have done brilliantly well. But I am not deploying any fresh money over here at this point of time. But neither am I exiting from the sectors at this point of time, because I really truly do believe in the longer term opportunity. But this is not a great entry point, honestly. So see, whether it is railway or defense, both the sectors I believe have been born in the last couple of years only. It is now that the Army, Navy, Air Force have started procuring from the local firms. Prior to that, everything was imported. So we will move away from importing to procuring it domestically because the government has essentially put a ban on importing. So there is a good visibility available to most of these companies with a 3-4 year. Some of the shipyards even have 7-8 years visibility because these frigates, for example, the ships take 7-8 years to build. So once they get the order, they know for 7-8 years the only challenge or the risk over there is execution. Or if the commodity prices go up and down, that could be an issue. But otherwise, they have visibility of business and they will continue doing well. In railways, in the last budget, railways had the highest increase in terms of absolute as well as percentage budget increase. And there have been, unfortunate incidents which is leading for us to modernize, electrify, and also expand the railway network. And finally, because of the dedicated freight corridor coming in next year, which has been a long time in the coming, the private sector will also get the confidence to start putting money behind, and they will also be start running their own wagons and rakes. So I think the sectors have just been born in the last 2 years. The fancy in the last 6 months has been really high. But at the same time, the longer term 10-year opportunity remains. If anybody is invested, expect no returns to negative returns for the next 18 months, but still stay invested.
And perhaps that is one of the most practical advices that has come so far in this particular show, which is that the theme remains robust, but prices have gone up so dramatically that the near-term upside seems really stilted at the moment. Ravi, when you look at other sectors, are there any pain points that you see? I mean, pharma, for instance, both of us know it did absolutely nothing for 5 years, and the kind of pain that we've experienced in front caps, mid caps and small caps in that sector has been a great learning experience. In this journey that we see the markets doubling for the next maybe 5 or 6 years, do you see any good pharma stocks that are just coming into your radar?
To answer your first question on the where do I see pain, I see there is being a lot of pain in the specialty chemical sector. I think that the market is underestimating the kind of pain that can come over there. Before coming to pharma, I'll just spend a couple of minutes on specialty chemicals. So the investment thesis in chemicals was that China was facing pollution issues, because of which they were shutting down production facility. And as they were withdrawing from the market, Indian players were getting space to capture that opportunity. And Indian government was providing them with the protection in terms of anti-dumping duty, which was actually adding to it. Now, the theme has panned out very well. 6-7 years, they have fantastic money they have made. But one thing we forget is that this anti-dumping duty is not forever. Second, the China was not shutting down production facility. It was only moving from a residential place to a remote location. So the Chinese re-entry into the chemical market and removal of anti-dumping duties is actually going to lead to flooding of the market. And I think next couple of years outlook, 1 to 2 years outlook can be challenging for the specialty chemicals. Coming to the pharma can actually be divided into various sectors. One is US focused API and formulation players. Second is domestic focused players. Third is diagnostics, hospitals. Those are the kind of segments. Most of the time we tend to understand pharma as a US focused generic players. That is a challenging segment. So no doubt the stocks have rallied because there is some reduction in the pricing pressure that these companies were facing, and there has been some one-off opportunities where companies have been able to capitalize, like Revlimid. So but beyond that, again, it's going to be a challenge. I feel that is a reversion to mean trade than a beginning of a secular trend for these large pharma companies. But there are other segments which are actually quite doing well. Sorry, I forgot to mention one segment, which is API CDMO space. That space is actually doing quite well. Diagnostics kind of is coming out of this post-COVID hangover because there was too much of business that they got. Now the growth rates are normalizing and the valuation had also steepened quite a bit. So those valuations are also normalizing. But I think that business remains solid and strong. Once you get a good opportunity, that is, I would be wanting and willing to buy over there. So not giving you a clear buy or a sell on pharma, so to say, but I would say avoid large pharma focus dependent on US business. and look for small companies that can actually do very well, in their particular niche.
Okay. Mr. Dharamshi, let me put across to you one more viewer question that we have received. And this question we've received from Faridabad. Samir Varia has asked you this question. And he wants to know from you, how would you advise investors to rebalance their portfolios post Q1 earnings?
Okay, I am presuming rebalancing is within equities itself, or is it a question as compared to other asset classes?
Equities. Within equities.
Within equities. So within equities, I think probably little bit of IT companies and pharmaceutical companies, the one we mentioned, the small niches, there has been, you can start building position in those, but don't build full position for another 4-6, maybe over a 4-6 quarters, rather than one go at a time, and start some of the these themes that have done very well, manufacturing within that, railway, defense, are some of those where you can actually look to trim. Again, I'm not suggesting that one should exit, but this is a very generic advice. There are people like me who can take 12-18 months of correction into the stride, and if you can do that, then this is the right thing to do. But if you cannot, and if you cannot see a 20, 30, 40% kind of a drawdown, then you will be better off trimming at this point of time, because there is a lot of fancy in this sector.
Right. Ravi, we've seen over the last 3 months or so a series of research reports coming out from some of the bluest of the blue equity stables, which is Morgan Stanley or Jefferies or BNP, talking about the wonderful time that is there for Indian equity markets over the next 5 years or so. One, are they over optimistic in their projections? And two, just a ballpark number where you see the Nifty maybe in November or December of 2024 after the May elections are over?
Okay, to answer your first question, I don't think they are over optimistic, but no one can be very sure about the timing of these things. So what we are expecting to happen in 5 years might happen in 7-8 years. I think that is the worst case that is possible. If we are expecting that Indian economy will grow at a nominal growth rate of 12-13%, we might end up growing at 10-11%. That is the worst case that can happen. And markets being markets tend to run ahead of what's going to happen in economy. So sometimes we will take 2 steps up and 1 step back. So that is what we need to navigate. But I think all the optimism about India overall is justified, very much justified. Regarding our second question about Nifty levels, I would have no idea how Nifty is going to pan out. But I can tell you this, which I mentioned in one of the earlier questions, which is I expect the entire market cap of India to go from $3.5 trillion to a $7 trillion economy. The rationale being that we will go from $3.5 trillion to a $5 trillion economy, and our profit to GDP will go from 4% currently to about 6-7%. And why will that go to 6-7%? Simply because the utilization levels are not yet beyond 75%. Raw material prices have been coming down, so that actually gives a good boost to the gross margin. Our tax rates have been reduced to 25%, and for greenfield capex it is 15%. Operating leverage will pan out. So all these things are factors that will drive the profitability up, and once that happens, we will have a company listed company pool of about profit pool of about $300 to $350 billion. Regular ROEs will go from current 12-13% to 17-18%. All this should ideally lead to re-rating of India even from here. But even if we presume that the multiples remain same, that would mean a doubling of Indian market, the entire market. So Nifty, let's take Nifty as a representation of that, and I would not be surprised in a 5 years horizon if we double that as well.
Okay, in a 5 years horizon, double that as well. Definitely, this will be music to the ears of investors who were thinking that, perhaps we missed the rally and the market Nifty is already at 20,000, whether it is the right time to invest or not. So, all of those fears rested at peace. But, I want to understand from you, you speak to a whole host of foreign investors, institutional investors as well. What is their idea of India at this current juncture? At these current valuations, we've already been seeing, the US Fed talking about still in a hawkish tone, although they're talking about that, we may be a little more careful when it comes to rate hikes going forward from here. But, we've already recovered what we had lost in terms of FII flows the last year. That's completely come back. Will they continue to pour in similar amounts of money going forward from here? And you've been talking about China plus one theme. I want to understand from you, a lot of experts are saying that current situation of China does warrant a lot of foreign flows to at least look at India as an alternate investment option. Your thoughts, sir?
No, absolutely. I think you covered or you touched upon almost all the points. So I've been speaking to a lot of foreign investors and asset allocators, and unfortunately, they are not heavily. Unfortunately for them, fortunately for us, they are not very heavily allocated to India. So, of course, there is a lot of money that has come in. But if you see in the context of India's market cap, hardly anything has come, so to say. And I have, so put yourself in shoes of the foreign institutional investor. You used to invest in Europe or within that Germany, UK, you used to invest in Russia, you used to invest in China. These were the markets that made up, Japan and Latin America. But now some of those markets are just gone out of the consideration for them. China shot itself in the foot when they kind of clamped down on tech. Now they are taking steps to attract the money back. But I find those till now whatever steps they have taken are inadequate. Valuations are no doubt very cheap in China, but deservedly so. In India also you will find, when commodity stocks sometimes are trading at very low P multiple, while some quality companies are trading at crazy multiple. But that gap always remains. That is because the quality of that company or that business is low. Similarly, China is now getting classified as a regulatory driven or a government driven. It's like a PSU stock. While India is actually one place where you can hope to earn grow at 15% and earn return on equity upwards of 15-18%. So Russia is out of the picture, China is out of the picture, Europe is struggling a lot, Germany or UK, those economies are in the brink of recession, if not already there. So India is actually providing a very viable alternative and a counter-cyclical economy to the whole scheme of things. So I will not be surprised that if this kind of the positivity that we are seeing towards India grows and grows far larger, and in fact it might so happen that it builds into a bubble also. So that is what I think is going to happen. I will not be surprised with a 1 year, 12-month kind of an inflow of about $80 to $100 billion into Indian equity markets.
Wonderful. And that's the Goldilocks scenario that many research reports over the last 3-4 months have been talking about, that FDI plus FII combined might just peak out above $100 billion. Till the time that becomes a huge asset bubble, Ravi, his PMS scheme and many of us would be enjoying that fantastic rally that is about to come into Dalal Street. Ravi, a point that I wanted to raise was a lot of people have definitely missed out on this wonderful gains that we've seen year to date on specific indices that we've already discussed. Imagine you have a customer coming in and he says that I have very normal expectations about life, and here is 20 lakh rupees that I want you to invest into Indian equity markets. How much of those 20 would you keep in cash, and where all will that 20 be deployed? The guy is into lookout of creating long-term wealth.
Yeah, so first of all, first thing you should do is have a perspective of 5 years, because this is not going to be a one-way journey. There will be hiccups along the way. Second thing to do is lower your expectation of return. Even though I expect to earn 15%, it will be better off if you expect 10-12% than if you earn 15%, you'll be happy. That's number 2. Number 3, I think in terms of deployment, I am actually going ahead and deploying 50-60% of the cash right away. 30-40% of the cash, I believe I will deploy over the next 2 to 3 months period, when either the market corrects itself, or if I land upon a chance upon an opportunity, or some developments happen which lead you to believe, okay, this opportunity is panning out here and now rather than in the future. So that is the kind of deployment strategy we have currently, and we will stick to it. Don't see a scenario of a major crash. Do a 10% kind of a correction is absolutely possible.
Okay, I'll bring to you another question coming in from one of our viewers from New Delhi. Shoaib wanted to ask you this, and I will, reiterate his question for you. What are the current macroeconomic factors influencing the Indian stock market, and how might they impact investment decisions?
No, so see, first of all, don't pay too much attention to the macros. Macros are always scary, and macros scare you. Interest rates are rising, inflation is rising, recession in US, recession in Europe. All these things are meant to scare you, while the money is made in equities by not getting scared out of them. Of course, you have to figure out whether these macro factors will lead to a better entry point for investment or no. That's all you have to think about. You don't have to worry about, there will always be some or the other reason which will be trying to scare you. So we have a good share of scary macro data at this point of time. One has to be actually scared when there is nothing to be scared about, or when people are extrapolating it to the moon. Sorry for the moon analogy, we actually landed Chandrayaan on moon, but just to, when people start expecting that nothing can ever go wrong, is when one should be really worried about. And right now that is not the stage. But to give you a sense of what are the factors which are playing on most people's mind, it is about whether US is going to enter a recession, is Fed going to pause, is RBI going to raise rates, or is it continue being on the pause? Those things are, I think, markets are going to be most sensitive to.
Okay, Shoaib, fantastic answer coming in for you. I hope you've got your masterclass going right there. I think it couldn't have been more simplified, more direct and more practical than how you have explained to him. One last question from our viewers, and Lucknow is where we are getting our next question from. Sahil has asked you this question, sir, and he wants to know, I'm sure that all of your answers have turned out to be, masterclasses in themselves, but this one is, what is the biggest lesson that you would like to pass on to first-time investors like Sahil in this current market scenario?
So, what I have learned from Rakesh ji, and I would definitely say, is that to be an investor, you have to be an optimist. Optimist with a dose of realism. There are a lot of smart people in this market who are very cynical and skeptical. They are not the ones who make money in this market, because they always have reason to be worried about. And making money in the market is not about your intellect. It is about your behavior. And your behavior, if you can control, then you can be way better than everybody else. When the market is zigging, you have to zag. And when the market is zagging, you have to zig. Be greedy when others are fearful. Be fearful when others are greedy. But figuring out that fear and greed is where the challenge lies. Have faith in equities, invest for the long term, take advantage of market volatility.
Wonderful. Just 3 lines. Be optimistic, remain invested for probably the longer term, and if the market is taking your case, please accept that, and then ride those downturns that have actually come in. Ravi actually mentioned that he's also looking at the possibility of a 30% correction over the next 5 years, and that 30% should actually be used as an opportunity to get back into the market, and those are going to be the volatile days that are possibly in the pipeline. 10% corrections.
It's just that we don't know when it will occur.
Absolutely, that's true, sir. That's true. Final question from our end, Ravi. What keeps you awake at night? Is it the sheer optimism that is across the length and breadth of the country? or are there some very serious pain points that are emerging which should be taken note of at least, if not acted upon?
No, so what keeps me awake at night is that I hope that the opportunity that is panning out in India sustains itself, and we are positioned for that, and we should not succumb to short-term vagaries of the market, or the thinking should not veer towards shorter term. We should focus on longer term, and I think, I mean, as much as the optimism is there around today, it's still not reached a level where it worries me that we are way more optimistic and we are borrowing and spending, or borrowing and trading in the market. Those things don't exist, so I'm not so worried. I'm not losing my sleep on market correction. I'm losing my sleep on that we will miss out on an opportunity to capitalize on.
Yes. Not only is that an opportunity which is going by the name of FOMO, the other problem with a lot of investors like Ravi faces the shortage of, the perennial shortage of funds to invest in absolutely brilliant ideas that are coming across on the Indian economy and on the Indian markets. Thank you, Mr. Dharamshi. It was such a pleasure speaking to you over the last 45 minutes. And when Ravi says that you should invest for the longer term, I'll just give you one statistic that is also available on his Twitter feed, which is Ravi Dharamshi 77. 1 crore rupees invested in October 2010 in VQ Growth Fund is now 7.89 crore rupees compared with 3.65 crores if you were invested in the BSE 500 index. So the money has grown almost 8-fold between a period of October 2010 to almost October 2023. 13 years is that, and remember, it's gone up 2x compared with the index, which has not done bad. So that is the kind of growth that has come in the past, and given the level of optimism that Ravi speaks about, this is what is also in the pipeline, if not more.
Well, okay. Many thanks, Shail. Many thanks, Mr. Dharamshi, for being with us on this special edition and sharing such brilliant insights for all our viewers. And with that, we wrap up this special edition.
Thank you.
But do stay tuned on to Business Today TV. It's an action-packed day. 2 p.m. you will see the RI AGM live on a BTTV platform. So do stay tuned on to for that. And of course, the market today shows will continue thereafter as well. Many thanks for being with us on this edition.
As soon as we get him in, we're going to be able to ask him some questions. In a truly, truly memorable day. Dr. Singh, while we're waiting, I'd like to start with you because you were there. You know, we saw it on TV. You were there.